Welcome to Season 8 of the FarrCast, bringing you insights into Wall Street, Washington, and the world. Now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It is the 17th day of August, less than 3 weeks to the presidential election. Ba-bump, ba-bump, ba-bump. Can you hear the drum beat marching us all forward right to that moment where we will find out? Not much, I think. It will probably be at least a week or two minimum, as what all the experts are telling Farr in Washington, till we find out who the next president of the United States is. And frankly, as I've examined this particular election and this contest, as heated as it may be, I'm not sure I care to know which one of them wins. I don't think there's going to be any joy tonight in town. So. Where are we? We've got a market that's still making new highs. Now, rumors on Wall Street are a big deal. Rumors can make you a lot of money or cost you a lot of money. The old line is buy the rumor and sell the news. And I'm going to tell you a rumor that's been going around that has happened to prove true, believe it or not, on Wall Street. The rumor has been, now listen to this, that there are 500 stocks in the S&P 500. People just refer to it as the S&P, and people forgot that there were other stocks, like 490 of them, because there have only been 7 stocks anybody's been talking about for 2 years. We've got all of those major leading stocks in the index that have been driving everything. But guess what? The other stocks over the past couple of weeks have been doing really well. Yesterday, for instance, the average stock in the S&P 500 did slightly better than the overall S&P 500 by about 0.1%. Did better. What does that mean? Okay, I'm going to just explain the math really quickly because I think it's important. People don't. Most people hate math like this. Please don't let your eyes glaze over, but I'm going to explain why this is important. The S&P 500, as are most of these indices, or I could say indexes, by the way, both are correct. Just, I don't know, which one do you think sounds fancier? I'm going with indices this morning. But all of these indices, most of them are cap weighted, market capitalization weighted, meaning that the biggest companies are treated more, are afforded more credibility, more importance within that index. Meaning, if I have 10 stocks in an index, one of them's 10 times bigger than everything else, they basically all 9 equal that 1 in terms of the way we calculate the performance. If the performance of the really big one goes up 2% and all of the others go up just 0, the index went up 1%, even though I've only got one stock moving, because it's the biggest stock there. Let me give you something else that I've always had to talk with clients about. This has always been one of those counseling points when you do the investment counseling, which we've been doing for a long time. Clients will say, oh, that stock's too expensive to buy because it's $200 a share. Don't you have any cheaper stocks that are like $10 a share? Get that all the time. And they want to say, well, I only have $2,000, I don't want to buy those $100 stocks. I can only buy 20 shares of that $100 stock. Why don't I buy 200 shares of the $10 stock? That feels better. I want to buy 200 shares. I don't want to own 20 shares. I feel like a little pisher if I only own 20 shares. Now, folks, if you've got the same amount of money invested, high roller, you put the same amount of money on the blackjack table, you're going to win it or lose it in the same way. Now, so it's the amount of money that you invest you need to pay attention to. Next, I'm almost done. Don't tune off yet. Almost done. That $10 stock that goes up $1 versus that $20 stock or $200 stock, $100 stock. If the $100 stock goes up $4 and the $10 stock goes up $1, do you feel better because your stock went up $4 that day? Because you made 4% while the $10 guy just made 10%. 4% versus 10%. You get it? These really big companies, here's the other point, have to move a lot. You have to see huge price changes to make the same sort of percentage differences on a smaller stock. Now, final note, you can go too small. You get down into the penny stocks, and they do indicate a much higher level of risk, and you will see more volatility, and they're not suited for everybody. But make the decision on the fundamentals of the company. And as we look at the S&P 500 index, you can't say indice, by the way, indice. You don't do that one. But index, S&P 500 index, the other stocks are now doing well. There has been a broadening there, other than just these big, largely tech stocks. So transports picked up yesterday. Transports have had a pretty good year. We look at transports because it's a sign in the economy that stuff's moving around the country, right? Retail sales comes out today. Consumers doing okay. What's going to happen with interest rates? Interest rates still are headed lower. The Federal Reserve has changed course. What do you do as an investor with all of this going on? We get you the best people we can here on the FarrCast, and you know his name. His name is Lebenthal, and we listen to Lebenthal. Good morning, Jim.
Michael, good morning. You give the best intros. I'm blessed to have you as a friend. How are you?
I'm just fabulous. I really am. I'm watching everything that's going on. I watched the Brett Baer, Vice President Harris debate last night, and I felt the same way I feel every time I've been watching one of these things ever. You know, he kind of hammered and she kind of danced, and I don't think either one of them gained any ground, and I don't think it changed anybody's mind at all anywhere, particularly the average Fox viewer. So there you go, Jim. Life is good. How about
Good
you?
answer. Good answer in two ways. One, your initial answer was you feel fabulous. You should feel fabulous. The
Right.
stock market is giving you reason to feel fabulous.
Yes, it
So,
is.
so are the financial markets in general. I want to come right back to that. The second part of your answer is digressing actually into the election. Yes, it's 3 weeks away. None of us know how it's going to turn out. None of us know how to treat it if you actually did have the results. We know I think it's true that the old saying is that you like divided government because that's the situation from which bad laws don't get enacted, right? If you have divided government, you have to make compromise. And with the Tax Cut and Jobs Act coming up for expiration at the end of 2025, that's going to be important to make sure that stupid things aren't done. But, I say all that about the election, and I want to go back to my original point. This is a infrequent time in the markets where it's kind of push the easy button.
Yep.
You know me, Michael. I hope that our listeners know me. I tend to be very analytical. I tend to, dive deep into the weeds, but I think this is a time where you can step back and look at the big picture and just analyze that there's some wonderful forces for the stock market. The economy is strong, period. The economy is strong, particularly the labor market. The Fed is cutting interest rates. I don't care how fast they're going to cut them. They're cutting them, and they should be because inflation's coming down. You've got China stimulating, and a heck of a lot of questions about that, exactly what the details and the size are. But the fact of the matter is, just like with the Fed, they are moving in a clear direction. All of this is benevolent for the stock markets. It's benevolent for profits. And on top of that, we are in the final 2.5 months of a year in which the stock market has been gaga. What
Yes.
happens is you crescendo in a year like this, you crescendo into year end. This is partly technical. I know somebody out there is going to say, well, what about valuation? And again, this is not like me, folks, but I don't care. Not right now. We can talk about that in January. And I don't mean that in a dismissive, in-your-face way. I'm simply saying that from my analysis, valuation is not the thing to worry about right now. It will be probably in the first or second quarter of next year, but right now, you've got anybody who's behind, and there's a lot behind the S&P 500 is chasing to catch up. Last thing they want to do is sell stocks. Last thing. They want to buy stocks wherever they can. Nobody wants to sell this late in the year if you're a taxable investor and take a big capital gain. This is a very benign environment for investors.
And yet some of them really may get advice to do just that, Jim, to take some of those capital gains, to sell some partial positions because positions have gotten, largely out of whack because some of these stocks have been so successful that you look up and you've got a outsized position that is letting inappropriate amounts of risk creep into your portfolio. So talk to your advisors, folks. You never want to let the tax tail wag the investment dog, right? Never want to do that. So, but Jim's right. There's a second, two rules on Wall Street. One, don't fight the Fed, right? Everybody knows that one. Here's another one. Don't fight the Mo. Don't fight the Mo. The momentum is always your friend in the short term. So if you're looking and you've been studying and doing the research that Jim suggests that he does and I do, and we've got a team of analysts at Farr Miller in Washington do that, and Hightower Advisors all over the country does that. Cerity Partners does that. You do that research and then you look at that stock and the stock market's on a tear and the prices are on a tear and you go, do I want to buy it today? Can I be a little more patient? If I'm a long-term investor and I want to hold it for 5 years, do I want to get in front of this freight train or not? And if it's moving down, it's another consideration too. You can ease your way in to certain stocks. And I know I sound like I'm talking about market timing, and actually I am. I cheat in this way. If I really see a real surge on the charts, on the technical patterns, I might time my entry. My
I
entry
don't
is going
think
to
you're
be based
cheating.
on fundamentals. No?
I don't think you're cheating at all. I mean, look, you and I talk about this a lot on the show. Market timing is foolish. And we're talking about people who say, sell all my stocks because so and so got elected, or sell 50 or 20%, 25% of my stocks. Those big moves are what we're talking about with market timing. If you've got a stock that you like, and it's had good momentum in it, and you're not sure the momentum's going to continue, just buy a little bit, put a toe hold position in, and be prepared to buy on the dips as long as the investment thesis hasn't changed, as long as the dip isn't because there's a fundamental change in the company. So, I will admit that if I had a ton of cash right now, it'd be hard pressed to put it to work in every stock that I own. But here, let's take an example. The airlines yesterday were up big. They were up
Yes.
big. And
Yes.
if you're a believer in airlines, and I happen to
Never. I'll never own an airline. Go ahead.
That's fine. Leave the specifics aside. Let me just,
Yes.
United Airlines reported earnings yesterday. It was up, I think, 11%.
Yes.
And this is the if, I realize it doesn't apply to you, Michael. If you as an investor said, well, I really want to own an airline right now, after a move like yesterday's, and the rest of the airlines moved as well, maybe you just buy a tiny little position and be prepared. Those sort of jumps up tend to give a little bit back, and be prepared to fill it more as it comes back. I don't think that's cheating on market timing.
Okay, well, and I want to be really clear. Jim is not recommending in any way that you buy any stock or that you invest in any sector or any industry or anything like that. Jim's not saying buy airlines, folks. He's not saying that. He's
just using an example. Just using an example.
Just as an example. That's all that is. Don't go buy airline stocks. Okay, so and that's not a recommendation from me not to buy airline stocks. You do your own research and make your own decision, please. Good. Okay, now that we've covered that, Jim, let me drill down, and I want to get to one question, and then we've got to finish up here. I've looked at a whole bunch of portfolios. I'm sure you have too, where there are these great legacy positions. You talked about the capital gains when we started, and I think that's where I'd like to end this morning. I looked at a great, very significant portfolio for a new client, $18 million for this client, big portfolio. And he's interviewing a bunch of different money managers, including us, and they're telling him all the different strategies that they do. And I sat there and looked at this. I said, I wouldn't do very much at all. I wouldn't change very much at all. Why? Everybody else wants to do this. I said, it's going to cost you a fortune. You've got all of these positions with huge capital gains. Do you really want to pay 25% taxes and then restart? Well, they tell me that this portfolio will grow better, that it'll be more efficient, it'll be more effective. Listen, you've built a portfolio by allowing some really good companies to grow. They will go through, because you don't own the S&P 500, you will have periods where you outperform the S&P 500 and underperform the S&P 500 with concentrated positions because you have tracking error. You don't match the index, therefore you're not going to track the index. You certainly shouldn't. Some points better, some points worse. But what you've built for yourself, in my opinion, with these blue chip stocks in your portfolio, is a great Volvo that is 10 years old with low miles. And people are telling you how to get more pep and how to get to 0 to 60 faster out on the highway. You don't care. You should not care about 0 to 60. You should not care about racing your Volvo. You should care about finding a good mechanic and enjoying your very lovely, well-kept car for years to come. Very hard to do. So, Jim, when you look at these portfolios, how do you advise those clients, particularly when markets are this high?
Well, it's a great question. And as you were talking, I was looking up a long-term chart of ExxonMobil because I remember 25 years ago when we would get inherited positions, ExxonMobil was the one that had like a $2 cost basis.
Yes.
And the issue is you can go through periods in the desert with any high quality company that you've owned for a long period of time. The long period in the desert is, say 2014 to 2022, where the stock just does nothing. And you may be looking at technology stocks and saying, oh, wow, they're going through the roof. I happen to agree, Michael, that the best thing to do is to hold these things and not take the tax hit, because inevitably, whatever the company is, and I'm not making a stock recommendation, starts to work again. But where the real risk lies in holding a concentrated position, and this is where you need a Michael Farr, or dare I say a Jim Lebenthal, to help you, is when that stock goes down and you're really now nervous and you're kind of kicking yourself and saying, well, I could have sold it higher and I should have. And you're maybe calling me up, you're calling Michael up and saying, why didn't we do this? There's a research analyst by the name of Adam Parker, and he's recently, in the last month or so, done a really good piece about 10 baggers, companies that go up tenfold over time. And inevitably, those companies go through a 50% drawdown along the way. Inevitably. That moment where you get a drawdown, whether it's 50%, 40%, 30%, is the moment that you most need to trust your advisor, whoever he or she is. But the most important thing, folks, is to have somebody who you believe who will get you through those downturns. This applies to the markets as well as individual stocks, because the idea is to sell high, not sell low. And the real risk in holding a concentrated position is you get flushed out by the nerves when it goes down.
You do need those folks who can look. We build those decisions on fundamentals. We build those decisions on research. So when you look at that company and it's down, and you look at the balance sheet and you look at management, you look at revenues, cash flow, and debt, and you say, if things continue to get bad, can this company continue to survive and thrive? And if the answer is yes, and you believe in management, then you make that decision. But it's always a value decision. There's always a bit of a guess in it based on experience. But those fundamentals are what will keep you safe over the long term, folks. A company with a balance sheet survives. A company with cash flow survives. A company overburdened by debt and that's getting squeezed is in trouble, and their fortunes can turn quickly. So if you've got that margin of safety in the balance sheet, you can make a longer term decision. What did I forget, Jim?
I think you nailed it. And I just want to repeat the most important part: fundamentals. If you're going to do this as an investor, if you're going to do it as an advisor or with an advisor, you have to really know the company. That's the thing that gets you through the downturns, is when you know the company, you understand the thesis, you've dissected the financials. That will get you through those periods where the market just doesn't know what it's doing.
Jim Lebenthal is a partner with Cerity Partners, CNBC contributor, my great friend. Thank you so much, Jim, for being with us. We always learn a lot.
Always my pleasure, Michael, really.
Ladies and gentlemen, we're going to be right back. We're going to talk a little bit about politics, and we've got more from Dr. Jeffrey Lacker last week. He does not see a recession anywhere coming. Please stay with us.
We hope you're enjoying this week's edition of the FarrCast. Please share us with friends and colleagues. And now, back to your host, Michael Farr.
Welcome back to the FarrCast. Thanks, Jim Lebenthal. That was absolutely wonderful, as are you each and every week. Good luck in Chicago next week. Jim's going to be traveling Chicago all next week. If you see him in Chicago, say hi. He's a very nice guy. All right, Mahaffey, politics. We cover Wall Street, Washington, and the world. Here we go to Washington and no Mahaffey. MIA. Harry's sitting in Mahaffey's chair today. Harry, Harry, you look good in Mahaffey's chair. You really do. You might even look smarter, Harry. This is good. Mahaffey's pretty smart.
I look smarter when anybody looks smarter when they're in Mahaffey's chair because it's the smartest chair in the business.
He's awfully smart. He really
He
is
really
awfully
is.
smart. Even his family members call his nickname is the Professor. Mahaffey's like he's like a kid. He's like 33 or something like that. I mean, he's not old, but boy, is he smart. Okay, ladies and gentlemen, last night we saw Brett Baer interview on Fox Vice President Kamala Harris. And the interview started out contentious and it stayed contentious. And I learned very, very little from either one of them. I thought that Brett Baer asked very pointed questions about immigration. Madam Vice President, you said this. And her answer was, that's not the point. The point is not what's happened, but where we're going. What the country needs is what we need to talk about. Frankly, ladies and gentlemen, she didn't do it as well as I just did it right there. So often in politics, now this is the curse of somebody who can talk a little bit faster than they can think, which is yours truly, by the way. That's I can talk a little bit faster than I can think, which has gotten me in trouble over the years. But I watch the vice president in moments like that. I used to watch George Bush 43 do the same thing, and God knows President Biden, but they don't. They keep talking even though they don't seem to be thinking at all. And I think, geez, if I could just sit in that chair for them, if I could just be the surrogate who steps in and let me go do the interview for President Bush 43, because he's making a word salad out of this. He's not getting to the point. He's not being strong enough. He's got a great point to make. He's got a great advantage, and he's just fumbling the ball. We've seen that a bunch, and there's a lot of pressure when a camera goes on. People have asked me in the past, why, so why are you on TV as much as you are, as opposed to other people? Is your track record that good? Are you really that smart? Whether you are smart or whether your track record's good, you do need to know largely what you're doing, basically what you're doing. But you need to be good on TV. They don't have you on TV if you're not good on TV. You have to be able to talk. You have to know when to smile. You have to look at the camera. You have to know when to shut up and when to be enthusiastic. And every so often, if you can get good and irritated on TV and get upset about something to go on a little bit of a rant, that is money on television. Money. All right. So it's a performance art. It's a performance art.
It's a performance skill too, and I think that that's something that a lot of people don't appreciate. You can have great thinkers that don't communicate well on radio or TV, and that's something that I think is missed sometimes when we want our politicians to be great performers.
You know, you're exactly right, Harry. I mean, and when you think we want likable, charismatic politicians too. They can't just be brilliant. Richard Nixon was brilliant, least charismatic human being maybe ever. Would drive people away, which you could get away with, I guess, during that time in the media if you were smart enough. But Richard Nixon, no, we want Ronald Reagan. We want Bill Clinton. We want Barack Obama. We wanted a version of the early version, at least, of George Bush 43. When he first became president, God, he was promising, and 9/11 really took him to a very different place. But these are very attractive, well-spoken people that you like having in your living room on your television, you know? So last night, we didn't hear that from Vice President Harris. We didn't get that person that we really wanted in our living room. Really didn't want Brett Baer in our living room either last night. He didn't look like a lot of fun. Now, I know Brett. I do not know Vice President Harris, but I know Brett. I've played golf with Brett. We are friends. And Brett's a very pleasant, very good guy to go hang out with. He's a hell of a good golfer, too. But he was being confrontational last night and hammering down on very important points. He was not there to be charming. That wasn't his job last night. So, and neither was Vice President Harris. And so kudos to both of them. Neither of you were charming. but as you get down to policy and issues, former President Trump's economic policy, Vice President Harris's economic policy, neither one are going to curtail this exploding deficit in this country. Neither one. We have an economic problem facing the country. Nobody wants to help curtail it. Why? Because they can't sell it, and it's not going to get them elected. So these are big issues. You know, Jim Lebenthal in segment one, Harry, talked about having a divided Congress so that they can't get much done. But we learned, and I don't know, Harry, if this is when I need Mahaffey here. Maybe it was Obama who started this executive order thing, where the president would come up with the power of executive orders to go and do things that didn't have to go through Congress. President Trump figured out how to do tariffs that didn't have to go through Congress. But there's a whole hell of a lot a president can do in terms of executive orders and tariffs and other things that can have a dramatic influence on the economy and on the society that set the tone for America. President Trump pulled us out, certainly in terms of foreign policy, pulled us out of NATO without a congressional vote. His rhetoric did it alone. His policy on Iran, and I don't know if you remember trying to get the North American Free Trade Agreement, NAFTA, redone, was exceptionally hard because he would not sit down with Canada and with Mexico so that they could talk about it. He would sit down with Canada, then he would sit down with Mexico, because President Trump can't seem to have a multilateral conversation. He can have a unilateral, bilateral, if you will, conversation. He can talk one-on-one. That's it. He doesn't talk to a group at any time. He doesn't negotiate with a group at any time.
And we live in a multilateral world. Can you negotiate those bilateral agreements in a multilateral world? Yes, you can, but that also it places limitations on the way that American foreign policy can work. And the renegotiation of NAFTA, which was overdue. I mean, it was a 30-year-old agreement. It needed to have some changes made.
Yes.
Absolutely. And it was very imperfect to begin with, as human endeavors tend to be. But that approach makes it more difficult. And that's something I think that we saw with the first Trump administration. Is that a precursor of a second Trump administration? I don't know.
Well, you begin with this idea of our place in the world, right? Do we have to be the world's cop? No, we don't have to be the world's cop, but we do have to protect our interests, U.S. interests around the globe 24/7. And that's the job of the President of the United States.
Mm-hmm.
Protect and further our interests, put forward, advance the U.S. interests around the world all the time. Protect our interests at home, protect our people, and domestic tranquility, and defend the Constitution of the United States. All those things have to happen. And you can't do that on an island. We live in a global fabric. I know you might not like it, but we do. We buy stuff from the rest of the world. We have to bump into those people in the rest of the world. And if we didn't, it would be hugely expensive to be really as isolationist as people are espousing that they'd like us to be, that they're hopeful that we wouldn't have to deal with any of those people. Well, the world doesn't work that way. And if we had to manufacture all that stuff here, you're not going to buy a $300 television set. You're not. It's going to be a $3,000 television set. And yes, we've got oil. And yes, we've got plenty of grain and food in the U.S. We got plenty. But there's a lot of stuff we don't have that lowers the cost of living for the most vulnerable among us. Keep it in mind. There's no easy answer out there, folks. There's no easy button to running the U.S. economy or the United States of America.
All right. Governance is hard. It's a hard job. Talk about, appearing on television being a hard job. Governing is hard. It's difficult. It's complicated, and it's messy. And we don't want that as the American people. As the voter, we want it to be easy.
It's messy. We do want it to be easy. It's not. And so I come back and remind everybody, I believe that every American should pray for the President of the United States every day. I don't care who the president is. You want the best president of the United States. You want that to be the most successful. We want the next 3 months of Joe Biden's administration for him to be the most effective, very best, wisest, most brilliant president he can have. At least that's what we should be praying for. We don't care whether he's a Democrat or Republican. He's our guy. right now. And whoever the hell the next guy is or gal is, we should need to say the same prayer because we want him or her to be the absolute best too. You know, Harry, who is the absolute best? Jeff Lacker's the absolute best, and he's coming up next. We call that a segue here for those of us who do media, a segue. All right, Lacker next. He's going to continue some of that discussion from last week, and we're not going to let him get too down in the weeds of economics. He's got an important message about why he doesn't see a recession on the horizon. When we come back on the FarrCast, please stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. Thank you for joining us on the FarrCast. And now, back to your host, Michael Farr.
Ladies and gentlemen, now a rare FarrCast economic alert. Before we get to Dr. Jeffrey Lacker, we just got news from consumer spending, and this actually changes what we had been even discussing with Lebenthal earlier, and that is that consumer spending has remained high. Retail sales, just reported, came in higher than expected. They came in at 0.4, up 0.4 in 1 month versus 0.1%, and better than the 0.3% forecast. What does that mean? It means that consumers have been spending at a little bit hotter rate. And ex-autos and all of those other things that they look at, that retail sales number says consumers are still spending, and therefore the economy isn't slowing, and therefore the Fed doesn't have to do anything else. The Fed doesn't, they're already started to lower rates, right, as an accommodation, not as stimulus, right? This is a taking the foot off the brake kind of a move from the Fed, not a putting the foot on the gas kind of a move from the Fed. So they are easing off the brakes, but the consumer is doing just fine. And one of the other things they're looking at, of course, the Fed always is how many people are employed, because if you have more people employed, those people are earning more money and they can spend out in the economy. Remember that the U.S. consumer is responsible for about 2/3 of the U.S. economy. If the consumer is doing well, the economy tends to do well. If the consumer is doing really well, you get inflation. If the consumer is doing really well, they create a lot of demand. And demand, if you've got a whole lot of buyers, they drive prices higher, and that's what we're watching with this inflation number. So those retail sales were up. If you took autos out of it, they were even higher, up 0.5%. Also, unemployment claims came in better than expected. They came in, unemployment claims, 241,000 people came in and claimed that they were now unemployed in the month versus an estimate of 260,000. So there were fewer people claiming to be unemployed than expected. And finally, the Philadelphia Federal Reserve Bank's manufacturing index was expecting to see an increase of 3%. They saw an increase of 10.3%. Manufacturing up. What does that mean? It means that all of that manufacturing that's covered by the Philadelphia Fed, and Philadelphia is a great manufacturing town. My friend Bill Stabert, his family's had a pasta, one of the largest pasta manufacturing companies in the country. So you don't think about a lot of the stuff that gets made in this country. Pasta's huge business. So 10.3%, it means they have to go out and buy all the raw materials for that. But it also means they expect to be selling it. So they're manufacturing, right? They're in manufacturing. And then we'll check also a producer price index later to see what they had to pay for all of that increased in the manufacturing index. We'll check that. So this is not an economy that's slowing. And Dr. Jeffrey Lacker told us a few days ago that he doesn't see a recession coming. He also said that he thought the Fed might be premature in cutting rates. I bet he's more convinced now and looking at these numbers, and he's sitting there saying, see, I told you this economy is doing better than you think. Let's hear what Dr. Lacker says right now.
And they're hoping that the momentum of inflation having come from 7 to 3 is going to bring inflation down to 2. There's still a case can be made for your position that 5.3 was enough and that inflation will come down. On the other hand, a case can be made that if they'd done 6, if they'd gone up to 6, we would have gotten inflation down to 2 by now.
Okay. I'm going to shift because these interest rates, a lot of people are saying, and when I go out and talk to folks around the country, they say, wait a minute, Farr. And I asked Polcari this. The Fed, you're saying that the Fed has cut rates. They're going to have 2 more cuts for rates. They're bringing rates lower. And then you just reported that the 10-year Treasury has jumped up to a 407. It's gone above 4%. The rates are going higher, but the Fed's lowering rates. How does that make sense to Fred and Ethel sitting at home listening to us? How do we explain that?
That's not my job. I didn't cut rates. I would have, cut by less or held firm. So
no, okay, no, wait a minute. But why? Just this counterintuitive. Do you understand that that's counterintuitive that the Fed is trying to lower the short-term rates and the 10-year Treasury goes higher? How does that happen? Why would the 10-year Treasury go higher when the short-term rates are being lowered?
So the question for the long-term rate is, where are short rates going to go in 3, 4, 5 years? And that expectation can change.
Okay.
And do Fred and Ethel, are they familiar with the expectations theory of the term structure?
No. Fred and Ethel are trying to figure out what rate's going to be on their credit card, what a auto loan's going to cost them,
I understand.
Mortgage rates. So I've said, Jeff, when the Fed started cutting rates and the 10-year was around 380, I said, I don't see any reason for the 10-year Treasury to go below 380. It seems like a perfectly reasonable level. And I don't care if they take rates down another 100 basis points. In fact, if it stays at 380, that would give you about a 5.75% mortgage rate as a low rate, which is what we've seen on some mortgage rates. I wouldn't expect, ladies and gentlemen, to see much lower than 5.75% mortgage rates unless banks get kind of desperate to get money to work. But do you think that's reasonable?
Yeah, I do. And if the rate goes up, it might, it could reflect markets thinking, well, maybe the Fed's not going to cut rates in the future as much as we thought. That's all I was saying.
Okay. So are you constructive for the economy? I want to change the subject to Israel for a second because Jeff and I went to Israel, believe it or not, over 10 years ago.
Oh my God.
Actually, 16 years ago.
Yeah.
But I told a story yesterday I want to tell our listeners about our trip to Israel 16 years ago. But Jeff, what do you expect? GDP growth for 25, 26? Where do you think we're going? And by the way, this $1.8 trillion damn deficit and a U.S. debt clock that's clicking right now at 35, almost $0.7 trillion. Honest to God, this is what keeps me awake at night, and that no politician wants to address this problem makes me out of my mind.
What's your question? Do you really want my GDP forecast for next year?
Yes, I do.
2.5. Real GDP.
Real GDP.
Yeah.
With a real GDP then at 2.5, that doesn't sound like the Fed has done anything that's going to get us into deep trouble yet. It sounds like you've got an expectation things are going to be okay.
Yeah. So there isn't a recession visible around the corner. I mean, what's visible ahead is more growth like we're seeing now.
Okay. So the U.S. economy is healthy and will
Yeah.
remain healthy into 2025.
Yeah. So remember what's sort of got everybody's attention over the summer was the unemployment rate rising from, over the course of a year, 3.5% up to 4, and then up to 4.2%. And the historical dynamics of the unemployment rate are that when it rises a little, sometimes it hits a tipping point and trips the economy over into everybody laying people off, and the unemployment rate rising dramatically by 2 or 3 percentage points, and the recession coming on. But that usually takes a shock. It usually takes some sector, some industry, some disturbance that either causes a lot of cutbacks in spending all of a sudden, or a lot of layoffs all of a sudden.
I mean, like a shock from Boeing or the dock workers strike. I mean, if that were to go on, I mean, is there anything? I mean, you're talking about something of a much larger scale.
Yeah.
Yes. Okay.
Yeah.
Much larger scale than that, ladies and gentlemen. Do you worry? I really want to get to Israel. I have continued to harp on this as I feel like a curmudgeonly old guy, but almost $36 trillion in the national debt is bothering me a lot, and that we keep adding to it when whistling past the graveyard. I don't understand. I mean, I understand that it's just politically untenable to address anything that the voters don't want to hear, but does that become an economic problem?
Yeah, I mean, it could well. I mean, if you look at, we were talking about the 10-year bond rate earlier. If you look at interest expense,
yes,
as a fraction of federal revenue, it's gone up a bunch. And if you look at projections, out into the future, 10 years ahead, which the CBO does, it's kind of stable at kind of a high fraction. But if interest rates go up a bit, like 50, 100 basis points, interest as a fraction of revenues could go pretty high, in which case we get into this loop where we're just churning out more debt, and it gets really hard to keep inflation under control. Okay. And that's a material risk. The weird thing, though, is that we're already in historically unprecedented levels of debt and deficits for peacetime.
Yes,
unprecedented. But at the same time, there is something that's been different this time than in the past, and it's the tremendous appetite for U.S. government securities from around the globe. People want to hold Treasury securities. A host of financial regulations have encouraged financial sector participants to use treasuries as collateral. You've got central banks of growing countries around the world that want to protect their currency against an attack, and the way to do it is to hold reserves, and those reserves are in New York in treasury securities. So that the vast and growing appetite for U.S. debt is the thing that saved us. Otherwise, interest rates would be higher, and we'd be there'd be some more political will on this, I think.
When the largest debtor nation in the world continues to add to its debt, when, Michael Farr at some point borrows yet another $1 million and goes to the bank and says, I want to borrow another $1 million. At some point, the bank goes, you've got a lot of debt, Mr. Farr. How are you going to pay all this back? Maybe why don't you find somebody else to loan you more money? We're not going to do it. At some point, is there a tipping point where people just say, yeah, no, and if I'm going to take it, you're going to have to pay me a lot more for that debt, more interest?
Yeah, for sure there is, but we don't know where that point is. That's the thing. If you're behaving like the U.S. Congress, you're just going to go to the bank until they say no. You're just going to keep testing them.
The developers, a lot of the real estate developers in and around Washington, great friends with them over many years, they used to joke, you can't borrow a little bit of money from the bank so that they're worried about it. You have to borrow a ton of money from the bank. When you borrow a ton of money from the bank, then they call and ask you how you feel every morning. It's like being the president of the United States and the vice president calls to check on your well-being.
Yeah.
Suddenly you become crucial to the bank, and that's how much you have to borrow. And the real estate developers figured that out. Okay, an Israel story. I told this story at lunch yesterday. Mention you by name, and if you don't like this segment, we'll cut it out completely. Okay, but Jeff and I were in Israel, and Jeff was the big featured speaker, and they actually let me say a few words at Hebrew University and make a presentation. It was a great honor to go over with the Jeff Lacker and the president of the Richmond Federal Reserve Bank and actually get to speak at this deal in Israel. We met at a private luncheon, though, with the former, and I'm using my air quotes on that, former head of the Mossad. The Mossad. This was one of the scariest guys I think I've ever stood in front of. He had a face that never looked like it had smiled. Never in his. I don't think that man may have ever smiled in his life.
It's a serious business.
And I mean, he looked like he could kill both of us without, taking a deep breath. And I'm probably right about that. He probably could have. So he was really angry. This was 2008, and we were in the middle of the financial crisis, and the message was fascinating to me. He took it out on Jeff, and it wasn't fun. And it wasn't fun to stand next to you as he was getting angry at you, because he was blaming me too, even though I was going to say he had no idea who I was. Let me tell you, folks, the former head of the Mossad knew exactly who I was, who my parents were, the names of my children, everything else. Okay. I mean, he's the head of the Mossad. You don't mess with these people. But he got mad at Jeff, and he said, your greed in your country, your economic irresponsibility, the leverage of this debt that has started this financial crisis has put the world in jeopardy. You all have great military strength and prowess, but your great power is in your economic power and your economic prowess. And you've put yourselves and the rest of the world in jeopardy to the extent, and he was angry, to the extent that we now have to have conversations with China. And we need to reach out and make agreements with China, and we don't want to. And you've put us in that position. And basically, you guys are a bunch of jerks. He did everything but shove his forefinger into Jeff's chest. And really, this is the way I remember this, Jeff. Have I got that right or wrong?
That sounds right. And I remember that sentiment other places in Israel as well. I mean, this was, I believe, the fall of 2008. I think it was November.
Yes, it was. We were there.
And we were there during the election when the election.
Yes,
I remember
Obama was elected for his.
I remember waking up at 3 a.m. to check out the returns. But this, I was appalled by what was going on in the United States as well, and rightly chagrined. And it's a tremendous responsibility the United States has to manage its economic affairs sensibly and responsibly. And I had the feeling that he had a good point, and that we in the United States at the policy level had dropped the ball and had really fumbled our responsibility to run a fairly stable economic platform and not send shockwaves out to the rest of the world's economy.
I thought really he was going to take you out back at the time. He had that look in his face, and at one point you probably didn't see it, but I did take a step backwards. I mean, I had your back. I had your back to the extent that I would have called your bride after whatever happened, to report faithfully. I wasn't going to get in the way of that guy's right hook. No way in hell. You'd be dead.
Well, the Israelis they're notoriously blunt. I mean, they just do not hold back how they're feeling about things. So
no. So just thinking about that though, Jeff, have we fixed, do you think, that part of our fiscal responsibility in our financial system? When I look at the leverage that we have and this, have we fixed it, or are we going to be in that position again? Do you think? What are the risks there?
I don't think that we've addressed some fundamental things, but there's hope on the horizon. So I don't think we're going to let Fannie Mae and Freddie Mac do the damage they did in the lead up to 2008. I think that the large financial institutions are pretty much the analog of your electric utility. They're basically so tightly wrapped in regulation. They're not going to take risks that mess things up. The risks are all going to be, they're pushed out to the fringe of the regulated banking system. But, you've got Silicon Valley Bank, and what happened in 2023 is an example of, there's risks are going to pop up somewhere and we're going to have to bat them down. In terms of macroeconomic management, the emergence in the last year or two of, a movement to address housing supply, I think is promising, because the tradition within, both parties has been to address housing affordability by subsidizing housing demand. And if supply is kind of constrained by a bunch of, NIMBY local regulations, subsidizing demand is just going to drive prices up, and not going to help.
Kamala Harris has said she wants to give a $25,000 tax credit to every young or new home buyer.
I have mixed feelings about that. So if you take a step back and you say, all right, we're going to reduce our subsidies for housing debt. So we subsidize housing debt massively.
Yes, right? Massively. Well, you've said this before. Who in their right mind would give you a 30-year loan at 5-point-something%? Nobody would do that.
And so we subsidize housing debt, and then we're surprised when housing leverage bites us, in the top. So if that represented a shift of subsidization from housing debt to housing equity, I would be all for it. But I have a feeling it's not.
No, it's just going to be another add-on giveaway, and they're going to keep subsidizing. They're just going to do it on both sides of the balance sheet. Okay, ladies and gentlemen, one thing I'd commend to you, if you start really feeling good and think you're having a good day, and you start to feel like everything's fine, look at usdebtclock.org. usdebtclock.org. It'll ruin your day. Just if you need to be brought down, if you're one of those manic people and you find yourself a little too up, pull up usdebtclock.org and take a look. It will not cheer you up, I assure you.
A lot of numbers there.
A lot of numbers, but look at the one on the upper left corner and how quickly it is. Yep. It's stunning. Dr. Jeffrey Lacker is the past president of the Federal Reserve Bank of Richmond, Virginia, professor of economics, one of the smartest guys you will ever hear anywhere, anyhow. And my great friend, you can hear how nice this guy is. He really is. You want to hang out with him. You want to go have a beer, I promise, with Jeff Lacker. Thank you, Jeff, so much.
Well, thank you. It's been a pleasure. It's great knowing you, Michael. You've been a great friend over the years. Really appreciate it.
Don't we have fun? Don't we?
It is.
He makes me a lot smarter, too. Ladies and gentlemen, that's it for another FarrCast as we cover Wall Street, Washington, and the world now in Season 8. We'll be back again next week. Thank you for listening. Please share us on social media. See you next week. I'm Michael Farr.
Thanks for joining us this week, and thanks to our guests, Jim Lebenthal and Dr. Jeff Lacker. And thanks to you, our listeners. We hope you enjoy the show as much as we enjoy making it for you. Please share us with friends and colleagues. FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, that it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And as always, we can be of assistance at Farr Miller in Washington. Please reach out to me at hjennings@farrmiller.com. We are here to help, and I'm happy to arrange for any of our listeners an appointment with one of our financial professionals to review your portfolio, your needs, and your goals. We love reading all of your notes, and we try to reply to as many as we can. You can reach us at hjennings@farrmiller.com. Let us know any questions you have about past episodes or questions you'd like us to address in upcoming shows. Take care, stay safe, stay healthy. We'll be back with you next week with scheduled special guest Dr. Jay Bryson from Wells Fargo. Thanks for listening to the FarrCast. Wall Street, Washington, and the world. Farr, Miller & Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr, Miller & Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller & Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.